You ever have this happen? You pick what you think is a great company. You do all your homework, the earnings report comes out, it's a massive beat, and your stock just sits there. Or maybe it even drops. It's one of the most maddening things in investing. Well, today, we are going to pull back the curtain on exactly why that happens. And we're going to talk about something called the exit liquidity trap and how you might be caught in it without even knowing, right? This is the big question. It happens every single earnings season. The headlines are screaming, record profits. You log into your brokerage account, you're expecting to see a nice pop, and nothing. The stock is totally flat. Or worse, it's in the red. It makes you feel like you're going crazy, like you're missing something fundamental about how all of this is supposed to work. So what is really going on here? Okay, here's a thought that might sting a little. What if all that good news, all that hype from the company and the media, what if it's not really for you? What if it's designed to get retail investors like us excited, to get us all to rush in and buy, creating this huge wave of demand right at the exact moment the insiders, the C-suite, are quietly selling their own shares? You think you're buying into a great story, but what you're actually doing is providing the cash, the liquidity, for them to make their exit at a fantastic price. It's a rough idea, but believe me, it happens way more than you think. All right, so let's start by digging into this. Let's really unpack what I call the earnings puzzle. It's that huge, frustrating gap between what a company says and what its stock price actually does. You know, from the first day we start investing, we are all taught this one simple rule. A company makes more money, its stock price goes up. It seems like basic math. Over the long haul, a stock's value is supposed to follow the company's profits. That's the whole deal, right? The company wins, so the owners, that's us, the shareholders, we win too. But here's the thing. That simple textbook idea often slams right into a brick wall of reality. The company reports amazing profits. They might even say the future looks even better. And yet, the stock goes nowhere. It just drifts. This isn't just a fluke. This isn't bad luck. There are some really powerful, kind of hidden forces at play, working right under the surface and, frankly, working against you. So what is this first hidden force? Let's talk about the number one culprit behind this whole puzzle. It's a concept called share dilution. And get this, it's estimated that a staggering 90% of retail investors totally ignore it, and it could be silently eating away at 3, 4, even 5% of your investment's value every single year. So what on earth is share dilution? Let's break it down. In the simplest terms, it's when a company just creates new shares, poof, out of thin air, and when they do that, the total number of shares out there goes up. So even though you still own the same number of shares, each one of those shares now represents a smaller and smaller piece of the total company. Your ownership stake gets watered down. This is the absolute best way to think about it. Imagine the company's total value is a big pizza. When you invested, that pizza was cut into, say, 1,000 slices, and you bought 100 of them, you own a tenth of the pizza. Awesome! But then management comes along and decides to cut that exact same pizza into 1,500 slices. You still have your 100 slices, but they didn't get you any more pizza. Now your portion of the whole pie is way, way smaller. And look at the math here. It just lays it out so clearly. You start with 100 shares out of 1,000 total. That's a solid 10% ownership. But then the company issues 500 new shares. You haven't touched a thing. You still have your 100 shares, but your ownership just tanked to 6.7%. You've lost nearly a third of your claim on the company's future profits, just like that. So you're probably asking, where are all these new shares coming from? Well, the number one driver is an item on the financial statements called stock-based compensation, or SBC. This is super common, especially in tech. It's when companies pay their people, especially their top executives, with newly minted stock and options instead of just cash. They are literally printing shares to cover payroll. Now, I know what you might be thinking. Hold on, what about stock buybacks? I'm always hearing about those. Aren't they the opposite of dilution? And you're absolutely right, in theory. But in practice? Well, let's just say buybacks can be a very, very sharp double-edged sword. So on the surface, buybacks sound fantastic. A company takes its profits, goes into the market, and buys up its own stock, effectively making those shares disappear. This reduces the total share count. It's the reverse of dilution. It makes your slice of that pizza bigger without you lifting a finger. It concentrates your ownership. And Wall Street loves it. The stock price almost always jumps when a big buyback is announced. But here's the dark side. See, a huge part of an executive's pay is often tied to a metric called earnings per share, or EPS. And there are two ways to increase EPS. You can either grow the company's total earnings, which is hard, or you can just reduce the number of shares. By using company cash to buy back stock, they can pump up that EPS number and unlock massive personal bonuses, even if the business didn't actually grow at all. And worse, they might be draining cash that should be going into R&D or new factories. A huge red flag is looking at the buyback to capex ratio. If a company is spending more on buybacks than on capital expenditures for its future, watch out. And who better to learn from than the man himself, Warren Buffett? He nails the one and only rule for buybacks. He says they only make sense if the company is buying its stock for less than it's actually worth. If they overpay, which they often do when they're just trying to hit a bonus target, they are literally destroying value. This is why the pros look beyond just buybacks. They calculate something called shareholder yield, which combines dividends and the net buyback effect to get a much more honest picture of how much cash is really being returned to the owners. Okay, so we've got this quiet dilution shrinking your ownership on one side, and we've got these buybacks that might just be a smokescreen for executive pay on the other. How in the world are you supposed to see what's really happening? Let's build you a new scorecard, a new tool for your investor toolkit. Forget the headline numbers for a minute. Here is the single most powerful check you can run. Pull up a company's financial statements and find just two numbers. First, their net income, that's their bottom line profit, and second, their stock-based compensation expense, which you'll usually find in the cash flow statement. Just putting those two numbers next to each other tells you almost the entire story of who the company's profits are really going to. And this visual just makes it crystal clear. The big blue bar, that's the total profit the company made for its owners. And that red bar, that's how much of that profit was immediately handed over to employees and execs by printing new stock. When that red bar is a big chunk of the blue bar, it's a massive warning sign that the owner's earnings are being siphoned away before you ever see a dime. And if you see that, your very next move is to go to the SEC's public database and look up the Form 4 filings for that company. That's where insiders have to report when they sell shares. High stock-based comp, followed by a flood of insider selling on Form 4s, that is the ultimate red flag. All right, let's wrap this all up. We've taken apart the earnings puzzle piece by piece. Now it's time to put it back together and give you a new, much sharper lens to look at every single one of your investments through. So here's your new checklist. First, headline earnings per share can be and often is totally misleading. Second, you have got to watch for share dilution from stock-based comp. It's shrinking your slice of the pizza. Third, be a skeptic when it comes to buybacks. Check that buyback to capex ratio. And finally, always see how much of the real profit is being paid out as stock, and then check those Form 4 filings to see if the insiders are cashing out on your dime. So from now on, your thinking has to go deeper. The old question, did the company have a good quarter? It's just not enough anymore. It completely misses the real game that's being played with the ownership of the company. And this is the new question. This is what you have to ask for every single company you own or are thinking of owning. Is management using the profits to make the entire pizza bigger for everyone? Or are they just using the good news as a distraction while they cut themselves a bigger and bigger piece, using your investment as their exit strategy and leaving you with nothing but the crumbs? Answering that question will change everything about how you invest.